Hello and welcome to this webinar. My name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be a host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Let's get started. This webinar is dedicated to the topic that attracts very much interest among traders. I have called it aggressive trading, or trading with increased leverage, or how to employ leverage and not to lose your account. Many traders want to start small and grow big in an attempt to build up a trading account, and many of these attempts are destined to failure because trading in whole and trading with increased leverage particularly is much more difficult than it is considered to be. First of all, if you trade with increased leverage, you will gravitate to day trading, and moreover, active day trading. For many traders, day trading itself is a losing game due to much conflicting information, numerous shakeouts, volatility breaks, and other elements of conflicting information. And when you especially try to apply greater leverage to this process, things become even tougher. But nevertheless, many traders start small and take risks. Some traders are risk takers by their nature, and this webinar is dedicated to them, to active traders, to active trading styles with high level of leverage. We will talk about key concepts of survival, and maybe you will obtain more clear vision of how it is possible to really build up your account and not to lose it in the process. 7 years ago I was in the same situation. I had small trading account, and thanks to world financial crisis I was able to increase this account to start trading full time. Later on, I had several large drawdowns that have given me important lessons about the market and about high leverage trading as well. I want to share it with you, so I invite you to listen and to make notes if necessary. Most of ideas discussed in this webinar were somehow used for trading, either from me or students of my educational groups, so it is based on practical experience. Before we start, let's take a quick look at the disclaimer. Please be aware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator or using a historical backtest before putting real money at risk. And now we are ready to start. I want to start this webinar with quotation from the book Zurich Axioms by Max Günther. In order to obtain a respectable return or to maximize one's well-being or career ambitions, an individual must assume a certain level of risk. So that is a quotation. Well, I have read this book, Zurich Axioms, early in my trading career, and it had great influence on my trading and my thinking in trading. And getting back to the process of taking risks. You can lose money in this process, and not only because lack of knowledge, but simple market conditions can be too rotational. That's reality. If we start with almost no trading capital, we have to take risks, and we have to learn how to take the risk maximizing the reward, having the odds of success on our side. Even if we are aggressive risk takers, we still have to know what to avoid and what to focus on, and I will do my best to help you with that during this webinar. If you want to trade under pressure, you have to prepare for the hard work. Trading with increased leverage is by definition trading under increased pressure. All those fancy pictures with a guy holding a laptop on the beach have nothing to do with reality. Well, they might occur in your life if you are a position trader who doesn't have to monitor small time frame charts, or if you have already earned some money and you take a vacation on islands just watching what is going on in the markets, reading news. That's okay. But for a day trader, things are so that you will likely have 2 or 3 monitors on your table, fast and reliable internet connection, and probably it will look like full-time job rather than vacation on tropical islands. Well, it is not about any monitors. Success is not defined by the number of monitors you have, but I wanted just to say that hard work is a real feature of active day trading and trading with increased leverage. On this slide you see one of my earliest trading performance curves. This is a real snapshot from a trading terminal. That time I was trading futures from my proprietary account and was not very selective in choosing trading instruments. You see that I've generated some profit since the beginning of this process, but I would say that this is luck. Such kind of trading cannot be called good at all. You see that if market conditions were not so friendly to my trading, if I started here, I could have lost this account pretty quickly. Yet I have made some money. Also, my market understanding was not very good at that time. I was simply following the price, employing price action patterns and my market feel. Yet this account was almost tripled within a period of 2 to 3 months, so this trading can be called aggressive. Here is another example of trading performance curve. That time I was trading an account of proprietary trading firm where I was passing through qualification program. It was 2012 and 4 years had passed after the first episode, so I have learned something from the market. This equity curve looks much smoother, even though there is a drawdown as well, but it doesn't exceed my loss limit, which was equal to $2,000. The drawdown was about $1,000 or so. Profit for this trading period was about 10% for the whole account and around 200% for the loss limit. So it is also pretty aggressive trading. Now let's try to analyze what are the differences between these two episodes. I remind you that it was day trading in both situations. In the first situation, I was trading many instruments. It was not only currencies, there were also treasury bonds, grains, stock indices and other instruments. Secondly, I was trading full-time or close to that. And finally, I had flexibility in risk management. There was no predetermined loss limit for the day, and if, let's say, day was rotational or neutral with numerous false breakouts, odds were so that I was unable to identify it very quickly and losses could gather into series. That's why volatility of the equity curve was not so smooth. As for the second episode, I was trading just one trading instrument, focusing attention on a single market. Then I was not trading full time. I focused on most volatile and potentially interesting time periods for trading within a day. And finally, I had rigid loss limit, which I was unable to exceed due to automatic risk management inbuilt within trading software. But in fact I didn't need it because at that time my discipline was greater than 4 years before. Now let's formulate key principles for effective trading based on trading employing increased leverage. It is first of all keeping a journal. Trading with small loss limit, you will have to get quick feedback from the market and be flexible. To get this done, you will have to be very disciplined in keeping a journal. Then you have to be well prepared for the day. In other words, quality of your homework matters. You don't have much room for mistakes, and the better you prepare, the more your chances for survival. Then it is essential to know your limitations either in psychological sphere or your trading method. Your method, whatever it is, just can't cover all important setups, all opportunities occurring in the marketplace. When you know your limitations, you will automatically focus on limited number of setups. And then if you trade with increased leverage, you will have to cut your losses quickly. And in many cases, much more quickly than for any other trading style. Then of course, you are going to have rigid loss limit. You can have flexibility in your trading ideas, but money management must be rigid. And also we assume that you have good understanding of the market you are trading on and have psychological robustness to execute upon your plan. These principles are pretty much the same as for any other trading style. It is not unique. It can be used not only for aggressive types of trading, but it can be used for any non-investment trading approach. Now let's make a brief overview of different trading styles that can fall into category of active or aggressive day trading. First of all, it is pure scalper, which can capture several pips in a trade and quickly get out. At the first sight, this trading style is the easiest in capturing quick profits, but in reality it is pretty hard to survive trading so actively. It's better to say that scalper is a relative term now, and we are talking about very short-term trading. And if you consider trading in this very short-term trading style, it will be better if you focus on the most liquid trading instruments like Euro versus American dollar for currencies and stock indices for futures. It may be E-mini S&P 500 or FESX for European futures. So the more liquid instrument is, the better for scalper. As for active day traders who might generate up to 30 trades a day, they can be more flexible and choose several trading instruments such as major currencies, crude oil, gold, and others. And finally, position day trader can trade any liquid instrument. Among trading styles listed here, I would choose position day trading. Remember that every time you enter a trade, you accept risk. The more you trade, the more risks you take. But really good opportunities don't occur very frequently. So to find many good trades within a day, you should have many monitors and trade multiple markets not correlated with each other. It is unrealistic for a trader because our capability of keeping attention is limited. If you limit number of trading instruments to follow, you also limit potential opportunities. So position day trading must be your choice if you want to keep above water and build your account. But finally, you have to rely on your trading temper, on your personality, and there is no common way to success. I guess that you would better test all of trading styles listed here and see what happens. And after that, you will have to decide what is better for you. And I remind you of a random test, which results show us that it is not so easy to gain an edge trading with small targets. I'm not saying that it is impossible, but it is quite difficult because you will have to be right most of the time. On the other hand, if you try to capture more distant targets having profit-loss ratio close to 7-to-1 and more, you have really good chances of not only survival but also making and keeping profits. That is argument for position day trading. If you capture a really big move, if you capture, for example, 70 or 80 or 90 pips with a stop loss equal to 10 to 15 pips having profit-loss ratio close to 7-to-1, 8-to-1, 9-to-1, it would be much easier to keep above water and generate profit over a large period of time. And now let's talk a bit about daily and weekly loss limits because it is a very important topic. If you are a position day trader, you can have initial risk per trade close to 2% of your capital. But if you are trading more actively, it's reasonable to reduce your risk to 1%. And of course I am talking now about percentage taken from your capital, but not from your maximum loss limit. For example, if you can afford to lose no more than 30% of your capital, you have no need to hold entire amount of money on your trading account. You can hold just those 30% on your trading account. If your capital is equal to $5,000, for example, and you can afford to lose $2,500, then you can hold $2,500 or $3,000 on your account to have margin for your positions. Trading Forex, you can have greater leverage than trading stocks or futures, so you can afford greater leverage and your money can sometimes work more effectively. And if you hold your absolute loss limit on the account, your risk per trade can be even 10% of the whole amount of money deposited. That's really aggressive. That's what we are talking about. Before we talk about any trading setups, I want to underline importance of following your plan. Having your loss equal to 5 or 10% of the whole amount of money deposited, you cannot trade randomly and you have to be as accurate as possible. So you have to know very clearly what you are searching for. It can be breakout momentum trades or trading false breakouts, but you have to know your setups very clearly. Well, it is fair for any other trading style as well, but especially for leverage-based aggressive trading style, it is very important. And keep in mind that trading under pressure will inevitably provoke you to have strong feelings about your performance. Sometimes it can be frustration or disappointment, sometimes it's going to be greed or fear of missing out a trade. And you will need to be very disciplined, very focused, and prepared to act under emotional pressure, which is inevitable. There is nothing glamorous about aggressive day trading. In reality, there is no free lunch. If you want to make returns much greater than average, you would be required to be much more effective than average trader. And it's reasonable to focus on limited time windows instead of trading every hour of a day or every 5 minutes of an hour just because you can do that. The most volatile periods within a day occur before the London Open or European session and right before the US session open, which starts at 8:30 Central Time. The London Open starts approximately at 7 a.m. GMT or Greenwich time, and pre-open session starts approximately at 6 a.m. If you look inside of a chart of any currency pair or a currency future, you might notice that periods with the lowest volatility take place before the London Open. This period is called pre-open. I will mark it with my drawing tool. You see that the volatility is the least within a day on London pre-open. I measure volatility with ATR, with average true range. Sometimes volatility can be the least for the period of 3 to 4 days. It is very good for getting inside a position. Markets are being manipulated during this period, especially for the Euro and British Pound. Thus we can see some false breakouts, tests. Sometimes it may be false breakout, sometimes it may be genuine breakout. If trading range of the Asian trading session was pretty tight, it can be broken out with further continuation, and it is a good time for position day trader because you can get in a trade with very low risk before the market becomes volatile. So you can be one step ahead of any big move, getting on a train which can bring you to a point of increased profit. That is a good way to be a position day trader. You have to focus on limited time windows, such as London pre-open and US session pre-open. Let's watch some charts. I show you now Euro versus American dollar, and the first thing that I'm doing, analyzing the market or trying to get within a trade, first I see the value of an ATR indicator on a London pre-open. For example, we see that here we have a low for the period of 2 days. This is the first day, this is the second day, and this is the third day. For the third day, volatility of ATR was the least, so we have a small trading range here at the London pre-open, and we can get within a trade. You see that this breakout was false. As I have said, this is the time for manipulations, and the second breakout was genuine. So the second breakout was good for entering a trade, for establishing a long trade for the rest of the day. And you see how it works. We had pretty tight trading range at the London pre-open, and then market has broken out the lower side of this range. So it is our point for entering a short position, but then we see that market is unable to generate or to sustain this breakout during the period of 1, 2, 3, 4 30-minute bars, so 2 hours. We see no continuation within a period of 2 hours, so basically it is a signal to get out of this trade. Then we see the breakout of the upper side of this range, and it is already the US session. Maybe it is a pre-open of the US session, but that is already an American session. And we see no continuation, nothing happens, so we see that the best time for opportunity is gone, so we have to exit our position and wait for the next setup. Then when US session comes into play, we have another setup, and we can generate a long position for the euro, establishing our stop using ATR indicator, multiplying it by 1.5 or using as it is, going with the breakout and holding our position for the rest of the day. Well, it's not very big deal here. Maybe we'll generate 3-to-1 profit-loss ratio, nothing more than that, but that's just an indication of how it works. And for the next day, ATR is even lower. It is even lower, and it generates the low for the period of 4 days. And you see the trading range on the London pre-open is even more tight than it was the day before. We see the test. Market is breaking out the lowest side of the range. We see the test, and here, of course, we had no elongation like in the previous example to exit a position, so we can quickly generate a loss in this case, but we have to re-enter at the upper side of this range. If we re-enter at the upper side of this range, we know that eventually the market will go to any direction, because such low value of ATR means that eventually such period of low volatility will be followed by a period of high volatility. We don't know the direction, so we have to maybe in some cases we have to let go the first signal and to accept the second signal and hold the position until the day ends. Well, sometimes we can exit this position using some kind of target. You can watch the webinar target setting and know more about the target setting process, but just if we even hold our position until the day ends, we also have more than 3-to-1 profit-loss ratio here, because we set our stop using ATR as a benchmark. ATR is pretty low here. It is equal to maybe 7 pips or 8 pips, so we multiply it by 1.5 and get about 60 pips or 70 pips in our position, having stop equal to 15 pips, so it's pretty good trade. And you can get better results if you combine this setup with strong trading market condition. For example, recently we had strong trading market condition on British pound versus American dollar, and you see several good setups here. First of all, we have the end of the year. It's December 28th. At December 28th, ATR was the least for the period of possibly 2 weeks or 3 weeks or so, or maybe more. So when you see such low value of ATR, you have to watch the trade location, and possibly it is a good entry point for a short trade here. Well, it's not that I'm showing you it because market already has broken out to the downside and that's a good trade. No, the lowest value of ATR shows us that it is possible to enter a good trade here. Later on we have several more situations. For example, it can be shown here at January 7th. It was the least for the least ATR for the period of 2 days, and also we had the good setup even here, but volatility was not very low here. As for the December 28th, let me show it you in more detailed mode. That's, oh sorry, it's December 29th. It's December 29th. That's a very typical example of a trade. First of all, you have pretty good trade location because market has initiated a correctional move before. Then it is located relatively close to the recent high of this correctional phase, and after that we have very tight trading range, very tight trading range with very low value of ATR indicator. So as a risk takers, as an aggressive traders, we want to have very good profit loss ratio to keep above water. So we can be stopped out from this false breakout, but if we re-enter the position here, we get the very good continuation for the day. So it starts with approximately 1.49 and the day ends at approximately 1.48, 48.10. right? So it's about 90 pips with a stop loss equal to 7 or 8 pips. So it is more than 10 to 1 profit loss ratio. I guess that this trade is going to be very good for an active day trader, for position day trader. Of course, we are not trading actively. We want to get inside a train and be with this position until the day ends or until it reaches some kind of target. And of course, if things were so easy to execute, we would have no reason to trade anything else but this setup. But of course, there are rotational days or neutral days that don't allow us to earn any profit, even if volatility was very, very low for the period of 5, 6, 7 or 10 days or more. For example, the day of November 23rd, we have seen on the London pre-open, we have seen this setup. We see the fake breakout or false breakout to the upside, and then we see breakout to the downside. Of course, we have no continuation here. We can count the bars, the 1, 2, 3, 4, 5, 6, and etc. So if we have 2 hours of price action with no continuation to the downside, then possibly the day would be rotational. You can exit this position without any regret. And in this case, the day is absolutely neutral. If you build the distribution of this day, you will see that most of the time market is trading around the central level, which is 0.7217 or 18 or 20 or so. And the next day, or the day of November 29th, when we see the lowest value of ATR for the period of 2 weeks, the day of 29th, it's the same like with setup that I was showing you on Euro versus American dollar. We see this trading range, and that is the London pre-open session. Here we see the breakout. The market also is not going anywhere for the period of 4 to 5 30-minute bars. It is about 2 to 3 hours. So we can drop our position and then re-enter a trade before the US session starts. Just this way, so we can re-enter this position here. But eventually, when market is not going to generate a move in any direction after the London pre-open, I would rather not enter the position the second time. If the market is not going anywhere, I would prefer to drop this position and search for another market, because at this particular case we had growth, but in other cases we might have just a neutral day and see no continuation. So this risk is not worth accepting. And now I'm going to show you the real-time market. I'm watching it right now. It's Australian dollar versus American dollar. At the first sight we see the low value of ATR for the period of several days, and we see pretty good trading range at the first sight. And we have seen the breakout. If we start to count bars, so candlesticks here, we have 1, 2, 3, 4, 5, and this is the 6th bar or 6th candlestick with that makes this market stay in the trading range. Market is not going anywhere, so market just stays in the trading range. I would say that the odds of decline here become lower. They become worse. So if I were in a short position, I would close this position, because probably this day will be neutral, or maybe it will be descending day but with very weak trending component. Profit loss ratio is not going to be very big here. The risk is not worth taking. Alright, we will continue talking about this topic in next webinars. I hope that we will have enough time to discuss all setups, all entry points, and other important aspects of aggressive trading, leverage-based trading. For now, we are finishing our webinar. Thank you for your attention. If you have any questions or comments, you can leave them below this video. I will do my best to answer all of your questions, so please be specific to receive a good answer. See you in the next video.